Welcome back. We are now in segment 6.13, and in this segment we will be discussing about fixed assets. So please recall that in the earlier segment we have started a discussion of assets. So we have discussed that there are four major headings under which you can classify assets. The first is the current assets, then we have the fixed assets, the non-current assets, and the intangible assets. So we have completed in the last segment 6.12. We have discussed about the various items that can appear under the current assets. So in this segment we will be discussing about fixed assets, right? So a company we usually will be having a lot of assets. So what are these assets? Land is an asset. We discussed this, right? A building is an asset. Machinery, furniture. So there will be a lot of assets. But when we say furniture, what we're actually referring to is a combination of various other items like tables, chairs, and desks, all put together. We're referring to a single name as furniture. So what actually happens in the balance sheet is a very a short format. So in balance sheet you have a single item called fixed assets. So here you have to show the amount. Maybe you'll have gross block, accumulated depreciation, and net block. These are the only three items where you can have the fixed assets. So here it is not possible in the balance sheet. It's not practical to list out every item. It's not at all practical to list all the items in the balance sheet. You can't have a balance sheet, right? You can't have a balance sheet where it is like this. So where it starts saying chairs, so land, building, tables, a moped, computer. This is a huge list. So usually that's not how balance sheets are prepared. Balance sheets will straight away mention what is the amount of fixed assets. So these individual items, they're maintained in what is known as an asset register. So there's something called an asset register. So in this register, each and every asset will be maintained. So in the register, you'll be knowing what is the purchase cost, the cost which that particular asset was purchased, the depreciation interest will be there, profit and loss if it was sold, right? So all this will be recorded in this register. But in the balance sheet, we'll be having a clubbed figure, a combined figure. So you have to understand that these are known as block of assets, because we're going to use this term gross block and net block. You have to understand what is this block. See, block of assets is say for example when we say a block of machinery assets, a block of furniture assets. What is this? It means a combination of all items under the similar class. So this is a same class. We are classifying, right? We are classifying all machineries under a single head called machinery. So this machinery will have various machines, right? You can have various machines, but put together you are calling it as a single item called machinery. So this is a block of machinery. Similarly, block of furniture. So that is what is known as block. It is a block of assets, right? So this is something which we discussed earlier in previous segments. The original cost of the asset is what is going to be shown under the what is known as gross block. And under depreciation, we also already discussed the concept of accumulated depreciation. We are not going to repeat that here. Please refer to the segment on depreciation if you're not comfortable with the concept of depreciation. So the fixed assets usually in the balance sheet will be what is known as the net fixed assets. So this is the figure which you're going to take in the balance sheet. So net fixed assets is when the balance sheet is going to ultimately when you're going to total all the assets. So assets have various assets like cash, inventory, debtors, various items, right? And you go to total under this column called total assets, right? Here under fixed assets, what you're going to take is net fixed assets, not gross fixed assets, right? It is going to be net fixed assets. That is what is going to go into the total of the total assets column. Okay, it's the net fixed assets. That is gross block minus accumulated depreciation. That is what we're going to take under the a net block, right? Please also note that there may be some expansion work going on, right? So we'll be showing it under separately what is known as capital work in progress. Say for example, a building is under construction. This is under construction. This is not yet completed into a building. So if it is completed into building, it will be shown under the block of buildings, right? We have a separate block of buildings, and in balance sheet it will be showing that under the buildings, but this is not yet completed. So what you show is shown that work in progress. So capital work in progress. There is a separate item. So what are the entries? Usually you will find in the balance sheet gross block, right? Less accumulated depreciation, and then you have something called capital work in progress. Finally, you arrive at what is known as net block. So this is how the balance sheet usually looks like. Okay, so let us take the example of Sun Pharmaceuticals. And we'll see what the balance sheet fixed assets schedule is going to look like. So in this example of Sun Pharmaceuticals, you can see here gross block at cost. This is the cost of the assets, the cost at which they were purchased. Then we have depreciation and net block. So gross block minus accumulated depreciation will be the net block, right? Here there is an item called intangible assets which we are yet to cover. We'll be covering it shortly, right? So an amortization. So just as in case of land, building, the physical assets, we have something called depreciation. In case of intangible assets, you're going to something called amortization. This is nothing but writing off the cost of the asset. What is depreciation? You write off the cost of the asset over the useful life of the asset. So if the asset is useful life is 10 years and the machinery cost is 100 lakhs, after 10 years, this is going to become zero. You're going to show the value of the machine as zero after 10 years. You're going to write off that, depreciate that value of the asset over the 10 years. Similarly, intangible assets also something has to be written off over a period. So just as in the case of tangible assets, you have depreciation. In intangible assets, you have something called amortization. Anyway, this is how the fixed assets schedule usually looks like. You'll be having the total of tangible and intangible assets, right? In most cases, you'll actually find only tangible assets, especially in small companies, mid-sized companies. You'll be finding no intangible assets. So this is what you usually find: gross block less accumulated depreciation and net block. Sometimes this breakup is also given. That is at the start of the year. What are the additions and deletions during the year? And what is the closing value for each and every item: gross block, depreciation, net block. Sometimes this is not given anyway. For small balance sheets, this is not given. But this is how the calculation goes on, right? Goes to gross block minus accumulated depreciation. Is what is going to give you net block, right? The point that we discussed earlier is there's a single entry called building, single entry called plant and machinery, vehicles, furniture. We don't know what is the breakup of this. This is what is available in the asset register. There will be a backup register called asset register. We'll have the individual items. For example, these vehicles, we have many vehicles. Maybe the company has a car. Maybe it's got a jeep. It has got a moped. Various items. Maybe a number of cars, 10 cars. So all those individually will be listed on the asset register. But whereas in the balance sheet, you're going to show on the block of assets. So block of plant and machinery, block of furniture, block of vehicles. So single item you're going to show in the balance sheet. The other point which you need to be aware of is something which we discussed is capital work in progress. So you see here, after arriving at the net block, gross block minus accumulated depreciation, right? Accumulated depreciation. You arrived at the net block. Finally, after all this total is done, then you are adding this capital work in progress. 2280.6 is the capital work in progress. So gross block, this is usually how it's done. Accumulated depreciation, and then to this figure, whatever you get, you add the capital work in progress. And finally, you arrive at what is known as the net block, the final net block, right? So for this company, the final figure is 10,224 million, right? Now, as a banker, there are a couple of points which you need to watch out for in the fixed assets. Whenever you see fixed assets in a balance sheet, there are a couple of points. One, gross block should not decrease. Gross block should not decrease. So please understand what we're saying. Gross block is the cost, the original cost of the machinery is purchased. It's not the depreciated cost. WDV, the net block is the depreciated cost. This can decrease because you are writing it off slowly. So this goes on decreasing and ultimately becomes zero. That is different. But gross block is something which will not decrease, right? So what happens? Banks usually sanction term loans for fixed assets. So this is your primary security. See, collateral security is different. That is the additional security. But primary security is the assets which are purchased out of the term loan. The assets which you purchase of the term loan are the primary security. So if you sanction a term loan for a project, and the company bought land, purchased land, constructed buildings, and purchased machinery out of bank funds, and some of their margin, of course. So this will be reflected in the gross block, right? So if the gross block comes down, it's a very serious issue. What it means is the company has sold off assets. This should make your heart skip a beat or two. Now this is a very serious issue. Without bank's permission, without bank's knowledge, it cannot sell off the assets. That's a very serious issue. And that's why gross block will not. I'm not saying assets will not be sold at all. Small items will be sold, right? Say the company has sold an old machinery and purchased a new machinery. But in this case, this is decreasing. Gross block is decreasing, but again, some part is increasing, right? Or some very old useless machine is there, useless, and you're selling it off. So gross block can come down, okay, marginally. Small amount is okay. But major part of a gross block, say gross block has gone down by 10%, 20%. That is a serious issue you have to watch out for. So always see that gross block is never going to decrease. Okay. That's the reason why in one of the sanction terms usually we'll find the company shall not dispose of any or sell any fixed assets without prior permission of the bank. Bank has a charge on the fixed assets. Okay. Whenever there is a major reduction, I'm not saying small reductions, there will be some deletions. See, even in the case of Sun Pharmaceuticals, if you see, there were some deletions, isn't it? See here, even in Sun Pharmaceuticals, if you see, there were some deletions here. See, these are all the deletions, gross block. That's all right, you see, but then it's not a very huge amount. There were some deletions. Maybe it was done with there were some deletions. So the gross block at the start, the plant and machinery at the start was 92 million. and 880 it sold, but they purchased new machinery. So this is all right. So they were selling some old machinery and purchasing new machinery. 5 was sold here, 21 was purchased, 7 sold, 20. So this is all right in the sense that overall, if you see, there is no reduction in the gross block. See, the gross block was, you see here, the gross block is increased. So in this, the deletions can be there. Company can sell assets. I'm not saying company cannot sell assets, but if so, replacement of old machinery, that's all right. But a major reduction in gross block, 10%, 20% goes down. Earlier last year, the gross block was 100 crores. Now it is come down to 80 crores. That is a serious issue, right? That's what I'm saying, right? So that is the first point you need to understand, keep in mind regarding whenever you deal with fixed assets. The other point as a banker which you need to remember is sometimes companies submit in the CMA data like this. Sometimes companies submit CMA data like this. Gross block will keep on decreasing. Just now we discussed gross block should not decrease. But what company has done here, see, they have taken depreciation instead of accumulated depreciation. So actually we should take gross block minus accumulated depreciation. This is not depreciation for the particular year. This is depreciation, the total depreciation up to that point. This is total depreciation. For example, if the asset is 5 years old, this is the total of depreciation for all years. Depreciation 1, depreciation for year 2, year 3, and so on up to 5 years. This is the accumulated depreciation. You should take here accumulated depreciation. But sometimes what companies do, they'll take, because of lack of knowledge by the accounting staff in the company, they'll just take depreciation for the year. This is the P&L value. Depreciation accounting appearing in the P&L value. And then there are the net block. So actually if you see, this is the correct, the net block will be same. So actually, see the correct calculation should be like this. So 100 is the gross block. First year depreciation 10 is 90. Okay. Next year the gross block still stays 100. The second year's depreciation of 10 will be added to this 10 and it becomes 20. Now WD will be 80. Again gross block will be 80. Now that next year's 10 will be added to the accumulated depreciation 20, 30. So this is how it goes. So gross block will be remaining same. Net block will come down. Whereas the company submitted calculation like this. Here also if you see the actually the WDV is same. In both cases the final figure, the figure which you are arriving at 90, 80, 20, 70, 60, 50 is same in both cases. The final figure is same. That is not the problem. But then here you're getting gross block is reducing. So what happens in the CMA data is all these are formula linked. Okay. All these are formula linked. So this balance sheet will be an input to what is known as funds flow statement, which we'll discuss later. We didn't come to funds flow statement, but this has been input to the funds flow statement. So if there is a reduction in gross block, so funds flow will be showing us sale of assets. So you'll be interpreting funds flow statement incorrectly. That's why whenever companies for lack of knowledge submit a CMA data like this, you have to just make a small modification and convert it into this particular format. The final value will be same. I'm not saying the company has arrived at a wrong figure. The final value is same, but this gross block is something which you need to ensure that it's not going to decrease. Okay. So we discussed briefly about capital work in progress. Work in progress is something that the work is going on. A company is maybe taking an expansion project. It is not yet completed. It is under progress, so it is known as capital work in progress. This is shown as a separate item: gross block minus accumulated depreciation plus capital work in progress. So one point you need to understand in capital work in progress is it is a once completed. So what happens with this capital work in progress next year? Once it's completed, say for example, this is 31/2013. But the next balance sheet date, if this is completed, what will happen? This will move to gross block. So earlier gross block was 100 lakhs. Capital work in progress is 20 lakhs. Now this becomes 120 lakhs. So this will be added to gross block in the next year. Once it is completed, this will be shifted to gross block. The other point which you need to understand is depreciation will not be charged on capital work in progress because this asset is not yet ready. So usually, so you won't be having any depreciation on capital work in progress, right? So with this we conclude this segment, and the next segment will be continuing discussion on assets, and the next segment will be discussing what are known as non-current assets. Okay, see you then.